What show? We haven't discussed this. We don't do pre-planning of the show because I don't want to. What should Dane? Who wants this?
I will. So if you think about a individual stock, mutual fund, the market is going to move and do what it does. The beta of an individual holding or mutual fund is a representation of how much it moves in excess or less than what the general market does. So if the market is a 1, beta will likely be something you will see it represented as like a 1.2 or a 0.8 or something like that. It gives you an idea of how much volatility this investment will have in relation to a benchmark of the general market, S&P 500 usually.
Kristen, what would you add to that?
That I don't know if it was explicitly clear there in Dame's explanation that greater than 1 implies more volatility, less than 1 would imply less volatility, just in case that wasn't totally clear.
Sometimes the word volatility can be confusing, but a oversimplistic way to think about it is risk and magnitude of risk. And so again, the market is deemed to be 1. So if your beta is more than 1, it's riskier than the S&P 500. When we talk about the market, especially with some of these things, we are generally talking about the S&P 500 as the standard bearer there. If it is less than that, it is less volatile, is less risky than the S&P 500. And Dame, here's why this is applicable. Let's say you're an index investor, like a lot of people sort of start out, and you're like, okay, I want to test this out. Maybe the stock pick, well, I actually want it to be a little safer than the index, or why don't I take a little bit more risk than the index? And this is initially a good measure to try to understand that. I think it's incredibly informative for the novice investor who are trying to stretch their legs a little bit.
Yeah, set some expectations of what you are looking for, maybe get you some insight on the future of that individual holding.